me introduce you. You don't need introduction. But for some people, I want to say that Mohnish is Indian American investor and philanthropist. He is managing partner of Pabrai Funds, which was founded in 1999 on principles followed by Warren Buffett. And he is good friend of Warren Buffett and Charlie Munger. He had famous lunch with Buffett, with his entire family and his friend Guy Spire in 2007 or 8. And today his fund is doing very well. He is following concentrated approach, and he is writer of Dhando Investor and Mosaic. He invests in India and emerging markets. Over and above investments, he has got deep interest in philanthropic activities. And Dakshana Foundation, which was founded by him, operating very well in Pune and other cities. And there are several Dakshana scholars who are getting admission in IIT, NIIT, and medical colleges, which is unparalleled. And last year, I came to know about this in Millennium MEM program on 8th of May. And thereafter, I wanted to go and see this, but because of lockdowns, still it is pending. So, Mohnish, how will you like to structure the session? Will you like to give some opening remarks? And then maybe it can be followed with question and answer.
Yeah, I mean, I'm actually more interested in hearing what you guys have on your mind. But first of all, thank you for the gracious invitation and also for the very generous intro. I appreciate that. I'm also happy to note the connection with Millennium Mams. It was fun to meet them in Omaha. I think that's a good group.
Yeah.
And I was very impressed with them having made the journey all the way. And I think it's a wonderful group and wonderful organization. Since many of you are from Calcutta, so it is my favorite Indian city. Of all the cities in India, Calcutta is my most favorite city. And I think mainly it is my most favorite city because it has the best food in India. So I always look forward to my visits to Kolkata because it's very varied, And my cousin, I have a few relatives who live in Calcutta, but one of them who's more famous than the others is my cousin who has Pabrai's ice cream in Kolkata, and he's got the Nalangur ice cream that has done quite well. So anyway, he's in the food business, and he makes sure that I go to all the hole in the wall dives in Calcutta and get all the different. Like he'll take me one place for sandesh, another place for something else. It's all very specialized. So, and anyway, I've always liked Kolkata. Most people don't spend enough time there. But I think I would really like to hear from you and what you guys have on your mind, and we can keep it free flowing from there.
Yeah, Mohnish, till recently you were following value approach. So last year, I understand you went through Nick Sleep's nomad letters and you changed your strategy from value to growth. Can you give us more insight on this change of strategy? And with this change of strategy, maybe you are getting more time. And in any case, lockdown gives a lot of time. So that can also help us to discover what else is being followed up by you in these days.
Yeah, so actually, there's a book that came out recently. It's called Richer, Wiser, Happier.
You have one chapter in this.
Yeah. So actually, the book was published almost the same time in India and the US. So there's a paperback version available in India, but I think Amazon ran out. So they probably maybe have done a second printing. It's an exceptionally well-written book, and I think you guys would enjoy the book. So if you have not got a copy, I would say that would be a good investment to make. So I received a galley copy of this book about a year ago. It just came out end of April, but I got it about a year ago. And because the author wanted me to just check, fact check everything and all that. And so he's an exceptional writer. So chapter 1 is mainly on me, but my favorite chapter is chapter 6. And chapter 6 is called Nick and Zach's Excellent Adventure. So Nick Sleep is a wonderful investor. He's based in the UK, in London, and he's been a friend of mine for maybe close to 20 years. I've known Nick for a long time, but sometimes it would be maybe even 4 or 5 years between me talking to him or meeting him. So we were in touch, but we were not in touch a lot. But I always enjoyed the interaction. But what I missed is that when I read Williams Williams' chapter on Nick and Zach, I realized that Nick had gone through an evolution as an investor, and he had actually transitioned significantly from Graham to Buffett to Munger, and then actually he went beyond. So I found many things about his journey very compelling. And so one of the things that him and his partner Case Zakaria did is they were managing about $3 billion in 2014, and at the time, the I think their largest position was Amazon. Amazon would have been probably close to a third of the entire capital, maybe close to $1 billion. And the UK fund regulators were giving them a lot of pressure that the fund is very risky and the fund is not diversified, etc. So they were kind of putting a lot of pressure on these guys to reduce the concentrations. And one of the things that was a kind of a bedrock of something they had learned over, they had started running the fund in 2001. It was a very small fund. I think when they started it in 2001, they may have had, 30-40 million dollars in it. And it grew. Investors came in over time and they also did well. So the bedrock for them was that they did not believe in having an overly diversified portfolio. And there were a lot of core principles that would be violated. And both these guys had never imagined, because when their fund started in 2001, they were employees of a large fund house in the UK called Marathon. Marathon Asset Management would have had maybe 50-60 billion under management. So these guys were analysts, and they allowed them to set up a fund just for the two of them. Marathon basically said, fine, you guys can have this fund in addition to doing your analyst jobs. And then after a few years, I think 3-4 years, they were able to convince Marathon management to spin them out, let them go on their own, which probably Marathon management at this point regrets. But anyway, they spun them out. And so Nick and Zach never expected to be extremely wealthy. But in 2014, when these UK regulators were giving them all this grief, they were each worth close to $100 million with all the fees and everything that they had made. So they said, why do we need to put up with this nonsense? So they emailed their investors and saying, we are returning all the capital and we are closing the fund, and we have other things we want to do with our lives. And they were both about 45 years old at the time. And I remember I got some calls, like some endowment in the US called me at the time, and they said, Mohnish, do you know that Nick Sleep is returning all our money? So I said, yeah, he's returning your money, but he told you what to do. So what Nick and Zach told them is, look, we are very concentrated in this fund, and probably even 10 years from now, the main positions will not change. They're going to stay the same. So we are closing the fund, but what you guys can do when you receive the money is just invest it the way we had it invested. And these are the 5-6 stocks that we have most of your money in. Put it in those stocks. You don't need to pay us any fees anymore. and you don't need to read our boring letters. You're done. You just take your money and put it in those stocks. So I told the endowment guy, I said, they told you what to do. So what's your problem? So they said, our mandate doesn't allow us to own individual stocks. Okay. So I said, let me just understand this. So if I set up a fund for you where you are the only investor and I buy the stocks that Nick is recommending, then that should be okay. And so this is kind of the craziness that goes on. So anyway, they got their 100 million each. They shut down the funds. And what Nick did with the 100 million is he put everything into three stocks: Amazon, Costco, and Berkshire Hathaway. And probably Amazon was maybe a third. Probably each of them was a third. Maybe Amazon may have been a little larger. And at that time, Amazon was maybe around $300 a share. Now it is about $3,300 a share. So for the most part, and then Zach put the money in six stocks. So he was a little bit more diversified. But from 2014 till now, Zach has made no changes to the portfolio. It's sitting exactly where the way it was. In the case of Nick, when Amazon got to 1,500, he got a little bit concerned about how much concentration he has in Amazon. So he added a fourth stock and cut the Amazon position in half. That fourth stock, ASOS, has also done very well. It's done as well as Amazon. So they have done better than probably any fund manager has done after they shut the fund down, while doing almost no work. I mean, he rides his bicycle, he loves to race cars. He took a 50-day kind of car drive with his daughter from Beijing, going across Europe, etc., all over. So what I realized when I read the Nick Sleep chapter is that they had figured out a number of things. And in fact, even when I had first started as an investor, I was a lot more of a person interested in rapidly growing businesses which generated high returns on equity. But then, in the mid 90s, when I started out, that's how I used to invest. But then we had the dot-com bubble, and I could see that bubble was coming. So things were getting very elevated. So I shifted to a more Grahamian approach. And it worked well because I think during the bubble, I had no losses. In fact, 99, 2000, we were up like 70% a year. And it went pretty well from there. But what I forgot to do was I forgot to switch back. So once kind of valuations came back, so first of all, growth and value are two sides of the same coin. Just because you buy Amazon doesn't mean it's not a value stock. And because you buy some coal company at 1/5 the book value doesn't mean it's a great value stock. So all businesses are worth the sum of cash flows they would produce over their entire duration, discounted by some reasonable interest rate. So if you're a very rapidly growing business, the cash flows are increasing. So you can pay more for it because you have a growing stream of cash flow than if you have a declining business or a flat business. That also has a value, but it'll be different value because those cash flows aren't growing. And one of the important things that Nick and Zach figured out was this concept of scaled economy shared. So scaled economy shared is a extremely powerful model. So what happens with most businesses is as they scale, they get operating leverage and the business gets more efficient and the profits increase. So for example, if I take a business like, let's say, MasterCard. So MasterCard basically collects like 20 basis points or 25 basis points on every credit card transaction that is charged to MasterCard anywhere in the world. So that 20, 25 basis points comes to them. And of course, their costs are a bunch of servers and a bunch of networks. They don't have much cost. And so as more and more transactions are going through MasterCard, their profitability keeps rising because their costs don't go up with. But what a company like MasterCard does, it keeps the spoils from the scaling. They don't share the scaling profits with the customers. So that is not what Nick is talking about. What he's talking about is enlightened businesses, which as they scale, give the benefits of that scale back to the customer. And there are very, very few businesses that are enlightened enough to do that. So a great business which doesn't exist in India yet, but maybe some of you might be somewhat familiar with, is Costco. And in fact, DMart, Avenue Supermarts, took a lot of lessons from Costco in their business model. The DMart business model is kind of a combination of Costco and Walmart, which is why nobody can touch them, and which is why they do so well. But the Costco model is that Costco, for example, has a rule that any product they sell, the maximum markup that they allow is 15%. So they will not have a markup more than 15% on any product they're selling. And the products are really cheap compared to the other competitors. So for example, Walmart or even Amazon, the typical margin is about 25% or 30%. And so pretty much almost anything you can buy at Walmart or Amazon, if you go to Costco, it will be maybe 10% cheaper. So it's a significant delta. Now, Costco can easily charge more. If they charge more, their profits will go up. But they believe that their lifetime profits will go down. And Costco does not think of itself as a retailer. They think of themselves as a buying agent for their customers. So they charge membership fees. I pay $50 or $75 a year to be a member of Costco to shop there. Pretty much all the 15% margin they take is used to run the business. They don't make any money on that. The only money they make is the membership fee. So that the membership fee is actually what shows up in net income. And so Costco does not think they are in the business of trying to maximize profit. They're in the business of trying to serve their customers. So for example, let's take like a category like wine, for example. So Costco has these specialist wine buyers who have gone all over the world and they have found the best vineyards. And then they have told those vineyard owners, listen, you don't need to do any marketing anymore. We will take your entire output. For the next 20 years, we will take your entire output. You just focus on making great wine. But we will take your output, but we will pay you a fair price, not the high price, because we are giving you a guarantee. As long as you keep your quality up, you're guaranteed that the business will come to you. And so they have great relationships with their suppliers. And when you go to Costco to buy wine, for example, in any wine store, the same wine will be 2 or 3 times the price. So their wines are extremely high quality. They don't mark up more than 15%. And the customers, cannot get that type of deal. So each time a new Costco opens, all the Costcos benefit because they have more scale and more buying power. So this scaled economy shared model that Nick Sleep honed in on, he felt it was an extremely powerful model. And it leads to very long runways. So Amazon follows the same model. It's also a scaled economy share. It believes in sharing as much as it can with the customer, keep the price as low as possible, all of that. And, look at lifetime value. And the third, Berkshire Hathaway, they have like Geico Insurance and so on. They are following the same track. So his perspective was that if you just had a portfolio that just followed this particular nuance of investing, you would do extremely well. And so when I read that, I was very intrigued. I said, I have no argument with what he's trying to say. I think the guy is pretty enlightened. So I contacted Nick again because I hadn't been in touch with him. Then he sent me all his letters. And actually, if you just go on Google and just do Nick Sleep investor letters or Nomad investor letters, you can pull up all the letters. They are on the internet. He's posted them. And I think those letters are really worth reading. So the chapter 6 is worth reading, but the letters are worth reading. And so I realized that which should have been obvious to me for a long time, is that you are going to do very well as an investor if you can identify businesses that have very significant growth ahead, that have high returns on equity, treat the customers really well, and have a durable moat and a durable competitive advantage. You don't necessarily need to just focus on the scaled economy shares that Nick Sleep focused on. Another insight Nick Sleep got was that he looked at this company, Walmart, and Walmart went public in 1970. Okay, so now Walmart has been public for 51 years. And the only people who have held the stock for the entire 51 years is the Walton family. So Sam Walton died. Sam Walton's children have started dying, and the grandchildren are still holding the stock. So the Walton family pretty much has not sold. It got split amongst many different Walton family people, but they have not sold the stock. They just get the dividend, but they have held the stock for more than 5 decades after going public. They held it even more if you look at the time it was founded. So Nick Sleep asked the question that if you owned Walmart stock as an institutional investor in 1980 or 1990, what caused you to sell the stock, right? Why would you sell such a great compounder? And the flip side, he asked the question is, if you own the stock of a company like Kmart, which went bankrupt, why would you keep that stock? What caused you to keep that stock? And so if you can answer those questions, those are really good questions to answer. And so what I realized is that in investing, probably the best way to approach it is to think of yourself as if you are the promoter of the business. Don't think of yourself as an investor in the business. Think of yourself as a promoter of the business and apply the same kind of mental model a promoter would apply. So in India, for example, we have lots of listed businesses which are more than 50, 60, 70% owned by the promoter. This is pretty common amongst listed businesses. And if you look at their wealth, the wealth is also very concentrated because so much of the wealth is just sitting in one business. But they understand that business well. In many cases, it's probably the best place for them to keep their money because they don't know where else they would do so well. So, for example, one of the things that I was thinking about in 2019, I had been making a number of trips to Turkey over the last several years, over the last 4 or 5 years. And I visited this company in Turkey in 2019, where the market cap was $19 million, 19. And the liquidation value of the business, they are the largest warehouse operator in Turkey. They have the largest truck fleet in Turkey. They have the largest rail fleet for rail transport in Turkey. There are many different businesses that are very good. The liquidation value of the business was somewhere between 300 million and $1 billion. So this company was trading at maybe, somewhere between 2% of liquidation value and maybe 6-7% of liquidation value, somewhere in that range. And so I tried to buy every share I could because I talked to my friend who had helped me understand some of the businesses. I said, the only question I have here is, am I dealing with crooks? Okay, that's my only, because I know the assets are good, everything is good. And there was nothing to indicate that the promoters were not straight. And so I I tried to buy every share I could, and we were able to, because Turkey has the investors in Turkey. Turkey is one of the best markets to invest in because the local population and even the local institutional investors have some of the shortest holding periods for stocks. So most of the local investors in Turkey believe that they will buy some stock at 10 o'clock in the morning, and by noon they should be able to sell it and make 10%. Okay, that's their, so the trading volumes are extremely high. So anyway, we were able to buy 1/3 of this business for $7 million. And I thought, okay, at that time my mindset was, okay, it's a good business. So they are the, like, Amazon, Carrefour, Alibaba, all these guys are renting warehouses, and these guys, they are like 100% leased. It's a very good business. They have like 12 million square feet of warehouses, and they have a bunch of other businesses. So my thinking at that time was that, okay, I know what the business is worth, and when it gets close to valued at that price, then let's say the valuation goes to 300 million or 500 million, if the intrinsic value has not changed, I can sell and move on, and it'll be a good investment. After reading on Nick Sleep, etc., I think of myself as the junior partner of the promoters of the company. I don't need to tell them what to do, or neither are they interested in hearing from me what they should do, because they know better than me what they should do. But happy to just cheer them all from the sideline. So now my mindset is not that I'm going to track what the intrinsic value is, and then when it reaches 90% of that or 100% of that, to sell it. My model is that as long as the business is improving, and as long as the trajectory of the business is that it's, over the longer term, increasing in valuation and getting better, we'll keep owning the business. And it could be 10 years, 20 years, 30 years. I don't know how long we will hold it. But so that mindset shifted. It shifted from, say, looking at every position as a, okay, how much is this worth, etc. Because if you look at a business like Costco, if you look at a business like Amazon, or even if you look at a business like DMart, for example, the key question you have to ask yourself is, what is the destination? What does this business look like in 10 years or 20 years? And what is the probability that it will look like that at that time? And most businesses, you cannot even try to figure out what it would look like in that time frame, because capitalism is so brutal. But some businesses, you might be able to get some comfort. I mean, Costco's business is so solid. They just opened their first store in China, and it got mobbed. I mean, there were lines, mile-long lines outside, people trying to get into the store. And if you fast forward 20 years, Costco could have 1,000 stores in China. We don't know. It could have 5 stores. It may not do well, or it could have 1,000 stores. We don't know. But the thing is that it's likely it does well. So if you were a shareholder of Costco, at this point, you just say, I'll just hold the stock. There's no need to make any other decision. So anyway, it's a long-winded answer to a very short question. But that's kind of what I got out of the Nick Sleep chapter and his letters. And I think you guys would enjoy reading both.
Yeah. I just downloaded this book yesterday, and we'll circulate in our group also. So Mohnish, you have been investing in India and other emerging markets. How has been your experience?
Well, I think India has been very difficult. And I think that probably if I had more of a Nick Sleep mindset which is what I focus on now, what I would have focused on in India, and what I will focus on in India in the future, would be quite different from the past. I mean, not that it doesn't work. I mean, like, for example, in 2015, I had made an investment in a company in Hyderabad called Rain Industries. And we still are a shareholder of Rain Industries. And in 2015, we had invested and owned 10% of the business. That's the maximum I could own, 9.99% as a foreign investor. That's the highest percentage we can own. And at that time, I could not see kind of a downside. It looked like kind of like the business in Turkey looked. So Rain was a relatively small company based in Hyderabad. Maybe their annual revenues were about $200 million or less. They did two acquisitions before 2015. I think one was in 2008 and the other one was 2011 or so. And these two acquisitions increased their revenues from 200 million to 2 billion. So they bought two businesses that were 10 times, that increased their revenue by 10 times. And both the businesses were bought, they were not Indian businesses. One was in the US and the other one was in Europe. And both these businesses, they raised basically high yield debt in the US, and they 100% debt financed both the companies with no recourse to the parent. So what he was able to do, Jagan Reddy, who's his managing director and the founding family, is he was able to convince the debt markets to give him about 1.5 or 1.6 billion in debt, which was the total purchase price of both the businesses. And the only collateral he provided to them was that if it didn't work, they could take those businesses. So basically, Rain had no downside. If these deals did not work, the India business would be unaffected. It's like I'm buying a steel mill for $100 million. Some bank is giving me $100 million loan. And I told the bank, you have the steel mill as collateral. And if the deal goes upside down, you'll say, Mr. Bank, here's the steel mill, here's the keys, warm regards, and I just leave. Okay, that's basically how that deal was done. And so the first deal he did, which was the US business, I think that was a 600 or 650 million purchase price, which was all debt financed. In the first year, the business produced more than 100 million of free cash flow. And it produced, continued to produce like 50, 60 million a year after that. So that business was already doing well. And then he used the US business as collateral to do the second deal, which was even larger, which was about a $900 million purchase, which was Rutgers in Europe. So when I looked at this company, these two businesses in the US and Europe were not doing well at that time in 2014, 2015. So basically, they were barely able to cover their interest expenses. And the India business was pretty small, so it didn't matter. But the market cap was 200 million. So the market was giving them zero credit for these international businesses because they felt like, okay, we don't know what is the future. But I could not see a way that the company is worth less than what it was trading at. And I could see, so at that time, I think the 2015, the share price was like 35, 40 rupees per share. And I could see that it was easy for them in a single year to make 40 rupees a share. So I said, okay, this is a pretty simple business. I'm just going to hold this stock for 5-6 years. There's going to be 1 year that's going to come because it's a cyclical business where the earnings will be 40, 50 rupees per share. And I'm done. At that point, the stock cannot be at 40 rupees. And so in 2017, 2018, that is exactly what happened. Their earnings in that year were $200 million. And the stock went to a market cap of more than 2 billion. So it went, more than 10x. And of course, I should have exited. But by that time, I had fallen in love with Mr. Reddy. And I actually found that he's a very good operator and he's a very honest guy. And that the business was actually getting better. So I felt like, okay, this is something we want to hold because he's improving the business and all that. Like, for example, some of the things they do, they spend more money that is required, several $1 million a year, to make the pollution from their plants be much lower than what is required by law. So that no one is asking them to do that. He's probably spending at least $10 million a year extra just to keep the pollution lower than any of his competitors, even though nobody's asking him to do that, because he believes it's the right thing to do. So it's like he just thinks long term, which is why I like the guy. And so anyway, it went from 40 rupees to 400 rupees, actually 40 from 40 to 450 rupees. And then it came all the way down to 100 rupees, right? So, and I'm just sitting there holding the stock. And then last year when COVID hit, it went down to 50 rupees. So again, and in fact, in 2020, when it went to 50 rupees, they've made so much money in the last 4 or 5 years. So actually, the stock was much cheaper than what it was in 2015 because they have added all these retained earnings. And so it was ridiculous. Anyway, so now Rain is sitting at like 170, 180 or something. And my love affair still continues. But the thing is, this is the kind of business that I would not buy with a Nick Sleep framework. The reason I bought this business was it was really, really cheap and there was no way to really lose money. But it is not a great business. It has a great operator. It has a great operator, but it's not a great business. MasterCard is a great business. Costco is a good business. Berkshire Hathaway is a good business. You can even say DMart is a good business. But I would not call Rain Industries a great business. I would say at best, it's a good business with a great capital allocator. So these are some of my learnings. So I think in India, one has to be, it's a minefield is the way I look at it. I think one has to be careful. And the issue is that I think what I run into in India is that the truly great businesses, generally speaking, trade at very elevated valuations. Once in a while, you find some dislocations. But like, for example, if I look at a business like HDFC Bank, right? So HDFC Bank is not just a great bank. It is probably one of the best banks in the world, not one of the best banks in India. It's probably one of the best banks in the world, just in terms of how it runs and how it's operating and all of that. And maybe when you put that lens on, it's a value price, but it's on normal metrics, it doesn't appear cheap.
Yeah, Mohnish, you had lunch with Warren Buffett, and then he also checked with you. Can he arrange your lunch with Charlie Munger? And then you found email went there in 2 days' time, and since you live in the same city, so you have developed great friendship. So can you give us some insights on your Warren Buffett and Charlie Munger learnings, which could help us in investing world?
Well, sometimes I have to pinch myself. I feel like I'm Forrest Gump, So first of all, it's like if you are living in the time of Gandhi or if you're living in the time of Newton or Einstein, and you get a chance to have lunch with these guys, would you want to take that opportunity, right? And so what I realized is Buffett was every year doing a charity lunch, and basically you could bid, the highest bidder will get the lunch. And I had made so much money off his intellectual property that I felt like, there's a tuition bill due. And at that time when I was trying to win the lunch, it used to go for 200,000 or 300,000. But in 2007, I think at that time my net worth was around like $80 million, most of it because of Warren and Charlie. So I said, Guru ko Guru Dakshana deni chahiye. So I bid on the lunch. We won the lunch, and then my friend Guy Spear and I, we went with our family. So it was a really wonderful. So one of the things that Buffett tries to do, because he has his lunch every year, right, is he wants to make sure that whoever has won the lunch thinks they got a bargain. Okay, so he comes trying to give you as much value as you can. So like he told us when he came that, look, we had the lunch in New York. He said, I have nothing going on all afternoon. I'm completely free. So whenever you guys are completely bored of me and you want me to leave, you let me know and I'll leave. But I don't have to be someplace in 1 hour or something. We have as much time as you want. So he puts you at ease. Like you can, within 10 minutes, you think you're having lunch with your grandfather, which is great. And yeah, so he arranged, I told Warren that, my wife, Reena, was a big fan of his, but her real love in life is Charlie Munger. So Warren is very competitive. He says, Charlie is a very boring guy. I'm the guy who's interesting. He's a useless old guy. He's just not even worth talking to. And he said, I'm going to arrange for you guys to meet Charlie because then Harita will know who's the better guy to have lunch with. So I thought he was just joking about this, right? But then he set us up to meet Charlie for lunch. And actually, I enjoyed the Charlie Munger lunch a lot more than the Buffett lunch, which was fun. And then that led to a nice friendship with Charlie, which I was surprised at. And so now Charlie is 97. He's going to be 98 in January. So I think probably maybe about a year ago he stopped going to his club for bridge. So I used to play bridge with him at his bridge club probably every 2-3 weeks. Usually every Friday afternoon, him and his friends will get together for bridge. So I had many bridge sessions with him and his friends, which was a lot of fun. And it's just a surreal experience because I'd meet him and Rick Goran and these guys, and I would ask them about things in the 50s and 60s and 70s, and different things that were going on at the time. And of course, I think every few months Charlie invites us at his place for dinner. In fact, I was just at his place for dinner probably 2 months ago, and he's doing great. He's all vaccinated and everything, which is good. But yeah, I mean, just extremely humble guy, probably the smartest guy I've ever met, and smartest guy I will ever meet. He's the most highest. I would say that Charlie has incredible horsepower and incredible wisdom and great humility, and he's a lot of fun to be with. So it's great. It's wonderful.
And your inspiration to start Dakshana Foundation in 2006? What was in your mind?
I think the thing is that the reason Dakshana was started is because I had no choice. So I think in India, a lot of people don't see it this way, but basically large inheritances to your kids and grandkids is actually a disservice to them. So for me, the journey was fun because we started from zero, kind of built it and whatever. And, Warren Buffett says that if you are Jesse Owens' son, the American sprinter, your son should not start 100-meter dash at the 40-meter line. Maybe he can start at the 5-meter line, but he should not start at the 40-meter line because he's not going to become a great sprinter if you give him that much head start. So basically, if you buy into the notion that very large inheritances are a disservice to your kids and grandkids, then I think there's no choice because the only thing you can do with your money is you can either give it to your gene pool or you can give it to society. Those are the only two choices. And if you're not going to give it to your gene pool and you want to give it to society, then it becomes actually a difficult question because it is much easier to make money than to give it away effectively. Giving money away is much harder, I feel. And so what I wanted to do with Dakshana is I wanted to not start thinking about giving money away when I'm 75 or 80 years old, because I felt like at that time will have no energy, and only thing I can do is just write checks or something. And I wanted to try to get started early, and I also felt like, see, in investing we try to minimize risk. In to do philanthropy well, you have to go high risk, high return, because you have to try to solve the problems that society cannot solve. So, poverty, illiteracy, healthcare, environment. These are all tough problems. So many billions of dollars are spent by very well-meaning governments and people, and we haven't solved those problems. So in philanthropy, what you really need to do is be willing to fail. Swing boldly and be willing to fail. And so I felt like in Dakshana, when I started Dakshana, I was about 42 years old. So I said, if 10 years we are just spinning our wheels, it's okay. I'll learn a few things, and then we'll get going from there. And actually, what ended up happening is that we got traction right away. It actually worked very well, almost from the beginning. Within a few weeks, we had a good model, and we pursued that. So it actually worked out significantly better than I expected. And then what has happened, which is really surprising, is that some very good people, started to support Dakshina. So, for example, RK Damani, DMart and RK Damani give us 7 crores a year. And actually, he would give even more if we could use the money. But our model, we can't use that much money. So he keeps asking, can you take more? I said, no, I can't take more. And then we have Prem Vatsa in Canada. He also gives us about $1 million a year. So yeah, Dakshina has actually worked out exceptionally. And basically, the idea is that what I want to get to is that one day before my death, hopefully there's $1 left, and everything else has been given away. So if I can do it perfectly, that would be the end result. But we'll see how it actually ends up. But so as time goes on, because of compounding, I need to keep increasing the engine for Dakshana. And it's not easy. I think our current engine works well, but it cannot absorb more than 7-8 million a year. And I think currently we are spending probably 3-4 million a year. So it will, once we saturate at the 7-8 million, then I think we'll have to think about what we can do next after that. But so far it's worked out very
well. Thank you, Mohnish. Can Kishore Bhai come?
Yeah, Mohnish, this is Kishore Shah. As you are aware, India is going through second wave of COVID-19, and it is quite widespread. And there is a lurking fear that even third wave may affect us. In such a situation, if you were to invest in India, would you wait for a deeper correction, or still you will look at specific businesses and go ahead? And if you were to invest, how would you go about finding companies, or would you be sector agnostic, or you would look at some sectors and then you will look at companies?
Yeah, so I think those are good questions. Well, I mean, I think that COVID can give you an opportunity. That's a possibility because it creates uncertainty. I'm always a bottoms up investor. So I always look at a specific business and I look at the kind of nuances around that business. So I think I've never taken an approach saying I need to have exposure to a certain sector or anything like that, or even a certain country or anything like that. So in my opinion, I think the first question to ask when you look at a business is it within your circle of competence? Is it something you understand well? And then the second is, I think the questions after that become easier because there are some businesses which may not get impacted much by COVID. Just the nature of the business, they just may not keep. I mean, let's say, for example, I look at a business like Geo, for example, right? What impact is COVID going to have on Geo? I don't think it makes much difference. In people need to communicate. They have bigger degree need to communicate when they can't see each other. So if anything, a business like Geo does better while COVID is happening. On the other hand, if there is some, let's say, private hospital, the government may put all kinds of mandates on them, right, during COVID, and it may or may not even be able to make money. So it becomes a lot murkier whether what would happen in the next year or two in other businesses. So I think that the question would be, can you see clarity on it? Like, for example, I think last year when COVID hit, I think airlines were not investable. You could not invest in airlines because it was so opaque. You knew air travel would go down, then you don't know how much the government will help. So some businesses will get affected a lot, and other businesses actually will do better because of this. Like, Zoom has done much better because of COVID. And so I think that, John Templeton used to say that trouble is opportunity. So when you have these types of events going on, the baby will get thrown out of the bathwater. And so if you can identify certain businesses that you understand well and their prospects, near term, long term, are pretty good, then those might be worthwhile. And I think especially if they fit into parameters like Nick Sleep, where they are high quality businesses at the core, then it's a good way to go.
So let me give you an example. Let's say the businesses which have been affected badly because of COVID are available at a much lower valuation compared to their past. Let's take the case of Indian hotels. Say it's available at a much lower valuation currently. It may not do well for next 1 year because of the effect of COVID, but one is sure that the business will last. Would you invest in such a business, or where you see deep value, or you would look at businesses which are currently growing, but the valuations are little elevated compared to the past?
So Indian hotels is a very interesting business to talk about because I actually looked at them. And I had a meeting probably a few years back, I think in one of the investor conferences with the CFO. And with due respect, Indian hotels is the poster child of a company that has had extremely poor capital allocation. Very, very, to put it bluntly, horrible capital allocation. So, for example, I'll just give you one example which I brought up to the CFO, and then his response to me was that he was not in the company at that time. Was the only way he could defend it. But they bought the Pier Hotel in New York many years ago, and they paid a very high price to buy the Pier Hotel. So the Pier Hotel is a great hotel, is an iconic property. But what had already happened before Indian hotels bought Pier Hotel was many of the best views, the rooms with the best views had already been converted into apartments, and they had already been sold. So the hotel was like 65% of the real estate had already been sold and given to these private owners. And the rooms that were left were not the prime rooms with great views, etc. But that wasn't even the worst part. The worst part was that as part of the transaction, all these people who had bought apartments in the Pier Hotel, they were guaranteed for the duration of the time that they owned these apartments, or anyone else owning the apartments, twice a day turn down service would be given to them for free. Okay, so New York has very high labor rates. You are going and fixing 60, 70 apartments every day, twice a day. It didn't matter what the occupancy was. You are losing money hand over fist. So I asked the CFO, what is going on here? Like, why would, I mean, if you just look at a spreadsheet when you were looking at doing this deal, there's no way you can justify it. The same thing happened with Taj, Boston. So I think my conclusion with Indian hotels is it's a great place to stay. And the guests are very well taken care of. And I want to stay there, but I don't want to put a penny into. So the thing is, it doesn't matter how low the price goes for me in that particular case. The thing is that I have questions. So, you know, the Tatas are wonderful, but the businesses that Bombay House had nothing to do with. Bombay House had nothing to do with TCS, and Bombay House had nothing to do with Titan. Those two businesses did extremely well. The businesses that Bombay House ran carefully with a lot of oversight, like, for example, Chorus Steel and Tetley Tea and Tisco and Telco and everything else that you guys know better than me, you know what the results are.
Yeah,
So
maybe Indian hotels was a wrong example, but in principle, if you get an asset which is currently affected by COVID, and you know that for next 1 or 2 years it may not do well.
Yeah, so I mean, I think if you say to me that the company has great capital allocation, okay,
yes,
it has to have great. And the second thing you say to me is that their balance sheet can more than easily handle whatever hiccup year or 2 or 3 is producing. And you also say to me that at the core, it's a great business. I hate the hotel business. Okay, you go on, you know, this Make My Trip or whatever, and you transparently see all the prices, and then you pick the lowest price. I mean, that's a useless business. Okay, your dumbest competitor is setting the price. But for example, you know, I hate the airline business too, but I have a lot of respect for Indigo. Right now, I still probably won't go into the airline business, but they are the lowest cost operator. They operate really well. Now COVID is hitting them really hard. I haven't looked at them. I haven't looked at the balance sheet, what was happening. But yeah, so if you can figure out that the core business is a great business, run by great capital allocators, looking out for the shareholders, there could be some great bargains. Okay. But please be careful. Some businesses you should only be a customer of, not an owner.
Mr. Pabrai, I have a question for you, sir.
Sure.
There is a saying that when you pay peanuts, you get monkeys. Now, if we go by the characteristics of great businesses who should be great capital allocators and cost savvy, then how do you filter the best value proposition out of such a lot? Because all those things are known to a lot of people, and the businesses are expensive.
Well, I mean, I think that, you know, like Charlie Munger says, why should it be easy to get rich? You know, so the thing is, you know, be patient. And when you find something that is, you know, widely mispriced, and you understand the asset well, you understand everything well, you can go in. And that probably may not happen maybe more than 2-3 times in 2-3 years or something.
See, sir, basically, let me give a brief background of who I am. I superannuated as Chief Finance Officer and President of Sri Cement. When I joined the company, it was 6 rupees per share. When I quit, it was 30,000 rupees a share. But I could never own it. There were 2 reasons. One was that I always used to find it expensive. And number 2, was that I did not want to go into any hassle with the regulators on insider trading kind of a point. And there was no ESOP in that company. I agree with your philosophy of great capital allocators and cost saving. But then it has been compounding 6 rupees to 30,000, 20, sorry, not 30, 20,000 rupees. It was a 0.6 million ton company when I joined. It became a 30 million ton company when I left. Net cash in books, no debt. All this was done. But then I was always bugged by the valuation the market was giving. And me being an insider, I knew that maybe this is a great business, but does it command that value? And that is a dilemma which I face now. That there are various great businesses compounding at great rate, good capital allocation. But how do you filter them?
Well, I think you bring up a very good point in the sense that if an insider like you could not forecast future cash flows 5 or 10 years out, then obviously when you're an outsider looking into a business, the job is that much harder. And the answer is that you only need one of those in your lifetime. So you have 50 years as an investor, and you only need to be right once on a business like that. So I'll give you an example. There's and I find this example even more compelling than Nick Sleep's example. You know, we have gone past an hour. I'm not sleepy, but I don't know what your normal timings are, Mr. Chandak. Have we both blown past your time, or are we okay?
No, we are fine, I think. That's all right.
Okay, that's fine. So there's a company in South Africa which is now 106 years old. They were like a book and magazine newspaper publishing company. The company called Naspers. Some of you may have heard of it. Naspers. So in 2001, Naspers, 20 years ago, invested $32 million into this Chinese company called Tencent. Okay, so they put 32 million into Tencent, and they got a 43% stake in that business. And what is mind-blowing about Naspers and the chairman, I mean, the guy who was the CEO, who's now the chairman, is through the 20 years that they owned it, they never sold the stock. And what ended up happening is the $32 million investment. So Tencent has a market cap now of about 700 or 800 billion US dollars, and they sold a little bit, I think, in the first 4 or 5 years, but basically they held about 1/3 of Tencent. So the Tencent position that they own is like around $200 billion. Okay, so this $32 million investment became 200 billion, became 8,000-fold return for them, and they have done extremely well on their other investments and other things as well. This wasn't just one aberration, but everything else pales in comparison to Tencent. So the company has probably got a value of about $200-300 billion at this point. And throughout this 20-year period, they got tremendous pressure from every corner you can think of to sell off the Tencent position. So Tencent became a $1 billion position, they were told to sell it. $10 billion position, they were told to sell it. $100 billion position. And to their credit, the two guys who were at the top pretty much told everyone to get lost. And even now, I mean, you guys may find this hard to believe, but at 700 billion, Tencent is deeply undervalued. Deeply undervalued, which is why they're not selling, right? So, abhi tak kahani khatam nahi. So, in the case of Nick Sleep, when he bought Amazon, I mean, he bought some stock at $30, $40. He bought some stock at $100. He bought some at 200, 300. He did not get that much return on Amazon by the time the fund was shut down, or even till today. I mean, even if you look at the most of the Amazon position is up 10 or 24. But in the case of Naspers, what blows my mind, and I studied these two guys at Naspers. I studied कि ये कौन सी हस्तियां हैं जो ऐसे अपना अपना धंधा चला रहे हैं. And what I discovered when I studied these two guys is this was not a fluke. This was not a bunch of gamblers. These guys are extremely good at what they do. And in fact, he understood. So one of the things that Nick Sleep understood is that exactly the Walmart story. So what they understood is they are like a founder of Tencent. And, you know, the Naspers has a very close relationship with Tencent. They sit on their board. They actually co-invest all over the world with them. It's a very good, close relationship they have. So basically, Naspers, which was a South African newspaper company, and the funny thing is they bought that $32 million stake from Li Ka-shing. Okay, so Li Ka-shing is a multi-billionaire in Hong Kong, has done extremely well, really smart guy. He's worth $30 billion. If he had not sold this position, he would be worth $230 billion. Okay, so he probably is looking in the mirror saying, why the hell did I sell this position at all? But anyway, the thing is, it would have been almost impossible for anyone to hold that stock for the 20 years that this company has held the stock. And they're not done yet. I mean, in my opinion, when I look at something like Tencent, it would not surprise me if they hold it for 20 more years. And the 8000X, they're not done yet. Abhi to kahani shuru hui hai. So the thing is that, you know, you don't need to be right that many times. What you do need is extreme patience. And when you find something that is incredible, you know, step up to the bat. Make it a meaningful bet.
Sir, I will top it up with only one comment. Hand of God.
Hand of God.
I'm sorry?
Hand of
I
God.
said hand of God.
Okay.
Mohnish, I have a couple of questions, slightly different.
Venkatesh, we have only 15 minutes, so ask one or two.
Yeah, just two.
And then there are other people waiting in the queue.
यहाँ पर एक question को आधा घंटा लगता है respond करने.
Mohnish, the first question I have is, see, India, for the first time in the last couple of years, has grown about 100 to 150 unicorns with $1 billion valuations, with probably $1 million, $10 million revenues, loss-making. The likes of Zomato, Grow, Zirada, the whole works across the spectrum. It's almost like India of US of late 1990s. What do you think of this unicorn investing? Because as you correctly said in your introduction, value and growth are two sides of the same coin, and it's up to the beholder how he sees the whole thing. So what's your sense whether of these top 100, 150 companies, would you look at, would these be on your radar of what could possibly be the next 100x stock from here? That's my first question. Second question is a little more interesting. How do you spend your day? What is your routine day like? What are your weekends like? My sense is that, and would it be similar to what your friends do, the big friends do?
Well, so let me take your unicorn question first. It's almost for sure that in that group, there are probably a few that will be outlier winners long term, and quite a few that may not, that may disappoint, is my best guess. But the thing is that depending on, you know, your frameworks and circle of competence and what you understand, you know, like I'll give you an example. So let's take something like food delivery. Okay, so some of my friends who are very good investors, they just tell me this whole food delivery business is total nonsense. Okay, it's very heavy logistics business. You have to have people, you got to do all this point-to-point stuff, all this stuff going on. And the restaurants are all upset because they have to give you 30% and all of that. So there's a lot of issues there. But the thing is, if you fast forward maybe 10 or 20 years, the situation could be quite different. So we are going through I mean, you're not going through so much habit change in India. I think in the rest of the world, there's a much bigger habit change. Because in India, you always had the ability for some random restaurant to deliver your food at home. And so on. The US, when I first came to the US, the only thing you could get delivered was pizza in terms of food. That was the only food delivery available. And now everything can be delivered to you. And, there are ventures like Cloud Kitchen and all of these things where they're working on the logistics, right? So there's one big warehouse which has got like 30, 40 different kitchens, and then maybe a drive-through in the middle, and the driver will maybe pick up 30 orders at one shot, and there'll be a very high density that 3 buildings he's delivering all 30 orders and so on. So it could change quite radically in terms of scale in the years, and then at that point brand matters and such. So it's possible that the top 2-3 food delivery guys in the end become incredible businesses, and they become a lot bigger than where they are today, and so on and so forth. What my take on all this is that there's no need to have envy or scratch your head or even try to say I need to figure out which one over here. Things need to be, at the end, they need to be a no-brainer. So when you're making an investment, in the end, before you make the investment, it has to be a no-brainer. Like I told you that even at 700 billion, I don't consider Tencent overvalued. And that's because I looked at all the pieces, what's inside those businesses, and kind of where things are going and so on. And there's just too many ways for them to win and too few ways for them to lose. So anyway, so the thing is, I think that the bottom line is that, you can look at these unicorns. You can, in most cases, they won't make any sense. Once in a while, you might find something where you have some experience and the pricing or whatever else might make sense. And maybe it makes sense at that point. But if you can live a very good life and you can actually be a very successful investor without making any of those bets. So it's perfectly fine. There's 100 different ways to move on. My schedule is pretty simple. I learned from Buffett and from Munger to run an empty calendar. So in a given week or day, I usually don't have any calls or meetings or anything scheduled. Even Mr. Chandak contacted us so many years ago for this talk, and then finally here we are. I forget, Mr. Chandak, when did you contact us?
Yeah, about 2-3 months back.
Yeah. So, like, for example, one of my rules is...
And we exchanged a lot of emails on the timing and all that.
No, so what I'm saying, like, one of my rules is I get so many requests for these things, which is fine, but I only do 2 a month. So once
that's what you told.
Once we book 2 in a month, that's about my limit of what I can do. Then I say, okay, so I think these sessions are set up into, like, for most of the rest of the year, so that's fine. So basically, I try not to put stuff on my calendar, and I usually sleep late. I usually get up late. Most of my emails go to my assistant, and then she gives me a folder at about 11 a.m. which has everything printed. Mr. Chandak got many notes from me, and so on. And basically, I find it, if I get a folder at 11 o'clock, by about 11:20, I'm done, with whatever I need to take care of for the day in terms of emails. And then whatever responses will come, we'll deal with the next day. And then basically, I like to read. And so what I read and such just depends on what is going on. And I grew up in Dubai and India with afternoon naps. So I take a nap most afternoons. I had a very nice nap this afternoon. And so basically, I read, I nap, I read, dinner, I'd like to read again. And that's pretty much I like to play bridge. So I probably play like, 7 hours a week of bridge. I like to ride my bike. So today, for example, I went on about a 20-kilometer bike ride. And usually on the weekends, I go on about a 40-kilometer bike ride. So I like to play racquetball. So now the clubs are open. So I play racquetball and tennis. So that's basically life.
Sir, to add to the point of Mr. Venkatesh, we just talked about your schedules. I understand that, sir, you don't have any subordinates, any research persons down the line to you. So then, in this world of so many information coming out and the research need to be done, then how you cope up with that individually, sir?
Well, I do now have a couple of guys, and that was really an accident because we had another business that they were involved in, and then I pulled them in to help me with some research. But basically, it's very directed, in the sense that if I'm looking at something, I might ask them to probe into certain areas and such. But Warren and Charlie didn't use anyone. I didn't have anyone for the first at least more than 20 years. So I don't think I think the thing is that if you invert the problem, you basically need to make only one or two bets in a year. And you have a whole year, you have an empty calendar, you can read all kinds of things. Many things like Indian hotels you're done in 5 minutes. So you can look at other things. You can be done with a lot of unicorns also in 5 minutes. So you just look at things that look more interesting and just hone in on those.
Hi, Mohnish sir. Zinal here. Thank you so much for
This will
taking
be our
time
last
out.
question.
Yeah.
But we are left with 5 minutes.
Thank you so much, Mohnish sir, for taking time out and speaking with us. I have listened to your conversation with the MBA students at Columbia. It was very interesting to know how Charlie Munger went, Warren Buffett went to prove that he is more interesting than Charlie Munger. So you also mentioned that you are bullish on the businesses which cater to the funeral services. In India, where talking about death is kind of considered a taboo, do you find it challenging to convince Indians on this country? Thank you.
I'm sorry, can you just repeat the last sentence?
Can you hear me?
Yeah. Just the last sentence.
So talking about death is kind of considered a taboo in India. So do you think it is kind of a challenge to convince Indian investors on this front?
Well, so I think that's a really good question. Basically, the death business, it's a metaphor. So there are many businesses in the death business. So for example, there are now, because we have all these bankruptcy laws and all this stuff in India, there is a mechanism for asset reconstruction. So all this distressed debt, which is the loans are upside down, the SL and all of that went through. There's a process by which that can be cleansed out and come out the other end, and people can buy it. Like the Piramals bought the DHFL debt recently, and they were bidding with Oak Tree, etc. So that business, the business like the Piramal buying DHFL, is a funeral services business. Okay, it is a death business because you're taking something that has basically died or needs to be given another life, and you're bringing it back. Or some company buying a bankrupt steel company or something is again the same thing. So the businesses that are in the business of either burying the dead or bringing them back to life are both really good businesses. And in the US, we have many examples of businesses that are in the funeral business. So, for example, one of the big US retailers is TJ Maxx. TJ Maxx has, thousands of stores. But what TJ Maxx does is they buy excess inventory that other retailers have made a mistake on. They bought 10,000 more pairs of jeans that they wanted, and TJ Maxx will buy them at 1/3 the price. And then they'll push them into all their stores. And the people who are coming to their stores know that they will get, it's kind of like a bazaar. You don't know what you're going to get because the inventory and what their deals are getting keeps changing. But TJ Maxx is a company that has done extremely well. And they basically are flourishing with the mistakes of others, right? There's a company I own in the US called Seritage Growth Properties. So these are the old Sears that have all been shuttered and shut down. And Seritage is redeveloping all that real estate, okay, into other uses. Sometimes they're becoming hospitals, sometimes they're becoming strip malls, whatever else, or apartments and so on. So they are in the rebirth business. So there is no taboo. Death is for sure. If we didn't think death was for sure, you have got enough data now in the last few weeks that death is for sure. And companies that are in that business will do very well. So in the US, when I first started investing, there were a couple of actual companies that are doing funeral services, and they've done a roll up. These were billion-dollar companies that owned thousands of funeral homes and all of that. It was an incredible business because I don't know how many people will die. I don't know who will die in Salt Lake City, but I know how many will die. Okay, and so the recurrence of that business. So funeral services business in the US, they never go bankrupt. They never have any revenue problem. Nobody ever asks how much you're going to charge. Okay, in every other business, people ask, like Indian hotels, how much is the hotel rate? Nobody asks when your uncle has died, let me go find 6 places which will do the funeral and take the lowest price. Okay, unless it was a really bad uncle, no one's going to do that. Okay, so basically you have pricing power. Nobody questions your margins. People just want things done quickly, and so on. So it's a great business actually. So I think if you think of it as a metaphor and look at businesses that are either in the death business or in the rebirth business, like asset reconstruction, those are really good businesses to be in.
Thank you, Mohnish. Will you take one more question and then we close?
Sir, you are an admirer of Warren, and Warren invests mostly in US. You have large of your investments in India, and I mean in percentage terms. So how do you see India in next 5-10 years in terms of GDP, or in terms of, say, per capita GDP, or in terms of listed market capitalization? And where do you see the value in terms of listed space? Which industry do you see value in the listed space?
Well, I mean, I think that my experience with India actually is led me to become somewhat skeptical. So the thing is that India doesn't grow because of the government; it grows in spite of it. Or, like they say, India grows at night while the government sleeps. So I just find that there are so many low-hanging fruit in India in terms of things that could be unshackled. So we went through some unshackling maybe 30 years ago. But still I find that there are huge amounts of market distorting regulations around, which really crimp what an entrepreneur can do. So for me, the main I would say question, and the optimistic part of me says that I hope and pray that these shackles are removed, because Indians are natural entrepreneurs. We would do really well if we are given the incentives and the government steps out of the way. So it has happened, but I just, when I look around, in different companies and different industries, and I look around in terms of, the kinds of regulations and things that we have in the US, I just see a night and day difference. And so I hope that the thing that is really kind of disheartening for me is India and Singapore had the same per capita GDP about 70 years ago.
Okay. Yeah.
70, 75 years ago, it was about the same. It is no longer the same, as you know.
Correct.
There's a night and day difference, and Singapore actually had pretty much no resources. There's just a small, swamp-infested area without any infrastructure or anything. So I feel that there is so much potential in India, and so much further it can grow, and can grow so fast for so long, but it would require significant changes to happen. I don't particularly look at which sector or which area. I just look bottoms up at businesses. So if I can find a specific business which has some nuances that are interesting, then definitely I would look at that. But I don't start at a high level saying I need to be invested in the software business and let me find the best software company or so on. I never look at it like that. But Mr. Chandak, this was a lot of fun. Thank you very much.
Yeah. Thank you so much for the insights you gave. Can I ask Isita to propose vote of thanks to you?
Hi, Mohnish. Thank you so much. Actually, this forum has had some phenomenal speakers, so I think it's a tough act to follow. But I must say that this is one of the highest attendance that we've had in these talks. So this was fantastic. Thank you so much. I mean, at this group, we all have read your books, and we followed you for a while. Even like the way you've explained your dhando, I think it was just so unique, and just just like this talk. Thank you so much for so crisply and succinctly talking to us about your thoughts and your insights and the way you approach investing. This is very helpful. Thank you so much. Hope you have a great day in Omaha.
All right. Thank you very much. It
Thank
was a
you.
lot of fun.